Alright guys, in this video I want to talk about the worst areas in the market to maintain a strict directional bias. So we'll go down to this level right here, and I want to frame it by marking off. I want to identify this, this price gap right here. Maybe mark it off by these lows right here. Again, doesn't have to be perfect, but essentially you get the idea. You have this area here. Now, a lot of times price will run up just into this level, this for lack of a better term, a gap in this area. And although you may see this sort of, this uptrend or on the low time frames, this is a good time to reset your bias up here. Let's try to find another example. Right, so we have this gap here filled. And again, we know which direction is going to play out in hindsight. But of course, in real time, we don't know that. But we do know that this gap here, essentially, if we're using the right side of the chart, really the gap is down here. You do have a clean break of this level right here. And then your point of release, your impulsive price move down here. But this area between this clean break and this impulsive price move down here, this is considered, this would be considered an inside gap. And I tend to like it when price, this point of release lines up a little bit further and lines up more in this area. Say if the point of release was up here, because then it offers less of an inside gap down here. It makes this level up here a little bit more tradable. But anyway, the point is this movement left this gap in price action here. So of course, while this is happening, maybe we identified what's going on with the liquidity up here, but we don't necessarily know that it's going to break down to this extent, right? We sort of play it level by level. Maybe we expect this gap to get filled, but price could always base off this level and start running for the highs. So essentially, to kind of answer the question is, when I see these gaps get filled, that's when I want to, be seriously taking profits and, taking a step back from the market and coming back with fresh eyes. Maybe if you trade the New York session, coming back the next New York session, or maybe even taking a session off, coming back the one after that. Because a lot of times that's a great place to take profit. Even if you plan to re-enter at some other point, right? Price comes down, fills the gap, and then starts marching higher. If you step back from the market, you could have reapproached the market with fresh eyes and identified this trade up here, got an even better trade in the same direction as the short up here. Let's go find another example of that. First, we got to find a gap in price action. Here's an example of the opposite scenario. So here we have this area here. Now, if we were long from here, we could start taking profit here and step back from the trade, right? Because we don't know, price could fill this gap and then proceed to run for the lows, right? It's just that's just the nature of price action. But let's say, for example, we did take profit here, and we take a step back from the market. Maybe we come back the next day. Well, we could identify that, okay, so we took profit here. Maybe we identify that these highs were violated, price came down, and maybe we just re-enter at the same area. It doesn't cost us anything, but it does allow us to approach the market with more of an objective bias about what's actually happening. Let's try to find another example of this. Here's a good example where, price comes up, fills the gap, this inefficient move. So that's a good time to also, take your profits, reassess, because ultimately you did want to, if you were looking at, maybe a break of structure here, this pickup in volatility, maybe you thought it was going to run for the highs. Well, you want to start taking profit as soon as this gap starts getting filled. Let's go find another one. So here we have one on the very high time frames, right? So we have, this is really where the summer accumulation started breaking out, and I'll mark this area off, but you can see it. I actually head along in this region, but this is a more of a high time frame trade. But I just want to mark off this gap right here because it'll be relevant going forward. So let me go to a daily time frame. Okay, so you can see here we had our Wyckoff accumulation, multi-month accumulation from this capitulation in May 19, all the way to July, so a 2-month accumulation. And then you get your spring, and then you get that gap, right, that we saw in the 4-hour. So that'll be significant going forward. I honestly haven't looked at this, but I would assume price comes down into this level on the right side of the chart and reacts. Oh, there we go. There's our base. So come down to that gap, react, right? We see that price gap. If we were short here, there's your ideal take profit target. So you can, again, you could always take profit, step back, and if you still need to get in line with the same trade idea, you can typically do that in that environment without missing out on much of the move, because typically price will stall around that region, and then if it's going to continue, you can just hop back on the trade.